Welcome back to Stock Predictor, where we talk about money, investing, and smart strategies to build your financial future. Today we're diving into one of the most reliable and proven paths to financial freedom, dividend investing for cash flow, and how you can actually retire on dividends. It's not a get-rich-quick scheme, it's a slow, steady, and intelligent way to build wealth that pays you every single month or quarter, even when you're not working. So, if you've ever dreamed about living off your investments, about seeing cash hit your account just for owning great companies, stay tuned because this is going to change how you look at money forever. Let's start with what dividend investing really means. When you own shares of a company that pays dividends, you're literally getting paid just for being a shareholder. A dividend is a portion of the company's profits that's distributed back to investors. So instead of keeping all the profits for expansion or executive bonuses, these companies share the wealth with you. That payment can be monthly, quarterly, or yearly, depending on the company's policy. Think of it like owning a small piece of a business that sends you a paycheck regularly, without you needing to clock in or do any work. Now, the magic behind dividend investing lies in consistency and compounding. Let's say you invest in companies that not only pay dividends but increase them year after year. This means your cash flow grows over time without you adding any more money. Combine that with reinvesting those dividends, using your payouts to buy more shares, and your wealth starts compounding. It's like a snowball rolling down a hill, growing bigger and faster the longer you let it roll. That's how people who start small can end up with massive portfolios that produce thousands of dollars a month in retirement. But not every dividend stock is a good investment. Some companies offer extremely high dividend yields just to attract investors, but they can't sustain those payments. A high yield can sometimes be a red flag, especially if the company's profits are falling or if it's taking on too much debt. What you really want to look for are companies with a strong history of paying and increasing dividends consistently. These are called dividend aristocrats. They're companies that have raised their dividends every single year for at least 25 years. Think of names like Coca-Cola, Johnson & Johnson, Procter & Gamble, or PepsiCo. These companies have survived recessions, wars, inflation, and changing consumer trends, and still kept rewarding shareholders. When you build a dividend portfolio, you're not chasing short-term gains. You're building a system that pays you to hold quality assets. This is one of the safest and smartest ways to achieve financial independence. Even when markets fall, your dividend checks can keep coming in, because companies with strong balance sheets and steady cash flow continue to reward shareholders even in downturns. That's why dividend investing is often called sleep well at night investing, because your portfolio works for you while you rest. Now let's talk about strategy. If your goal is to retire on dividends, you need to plan for cash flow that covers your living expenses. Suppose you need $4,000 per month in retirement. That's $48,000 a year. If your dividend portfolio yields around 4%, you'd need about $1.2 million invested to generate that much income. But don't panic if that number sounds big. You can reach it over time by consistently investing, reinvesting your dividends, and increasing your contributions as your income grows. The power of compounding will do the heavy lifting for you. Let's take a smaller example. Suppose you invest $500 per month into high-quality dividend stocks. That yield an average of 4% and grow their dividends by 6% per year. Over 20 years, you could end up with a portfolio worth around $300,000 to $400,000, generating about $12,000 to $16,000 a year in passive income. That's a solid supplement to Social Security, pensions, or other investments. And if you keep going for 25 or 30 years, the numbers become even more impressive. The earlier you start, the easier it becomes to build financial independence. Another key point about dividend investing is tax efficiency. In the U.S., qualified dividends are usually taxed at a lower rate than regular income, often around 0% to 15% depending on your tax bracket. That means you keep more of what you earn compared to someone earning the same amount from a job. And if you invest inside a retirement account like a Roth IRA, those dividends can grow completely tax-free. That's how you can maximize your compounding power without the tax drag slowing you down. One of the most powerful habits for dividend investors is to focus on dividend growth, not just yield. A company paying a 3% dividend that grows 10% per year will outperform a 6% yield that never grows. Over time, your yield on cost, the return you earn on your original investment, can skyrocket. For example, if you bought shares of McDonald's 20 years ago, your initial dividend yield might have been around 2%. But thanks to years of consistent dividend growth, that same investment could now be paying you an effective yield on cost of over 10%. That's the long-term power of patience and reinvestment. Now, you might be wondering which sectors are best for dividend investing. Traditionally, industries like consumer staples, utilities, healthcare, and energy have been strong dividend payers because they generate steady cash flow regardless of the economy. Think about it, you'll always need electricity, healthcare, and basic goods. These companies have stable earnings that allow them to pay dividends reliably. Real estate investment trusts, or REITs, are another great category because they're legally required to distribute at least 90% of their taxable income as dividends. That makes them powerful cash flow machines for investors who want monthly income. You can also use exchange-traded funds or ETFs that focus on dividend-paying companies. For example, funds like SCHD or VIG track groups of high-quality dividend stocks, giving you diversification and steady income without needing to pick individual companies. This approach is perfect for people who want a hands-off investment strategy that still generates reliable cash flow. The next thing to consider is reinvesting your dividends, especially when you're still in the accumulation phase. Reinvesting allows your money to buy more shares automatically, increasing your future dividend payments. It's a self-growing cycle. Once you reach retirement or your target income goal, you can turn off reinvestment and start using those dividends as your regular paycheck. That's the beauty of this system. It transitions seamlessly from building wealth to providing income. Retiring on dividends means your assets are still working for you. Unlike selling shares or withdrawing from a traditional investment account, which slowly depletes your principal, dividends give you a renewable income source. You can keep your core portfolio intact and live off the cash flow. This creates financial security and peace of mind, knowing your money isn't running out. Of course, no strategy is perfect. Dividend investing isn't immune to risk. Companies can cut or suspend dividends if business conditions worsen. That's why diversification is essential. Spread your investments across sectors, industries, and even countries. Don't rely too heavily on one company or one industry. It's also wise to monitor your holdings occasionally. Look at payout ratios, earnings growth, and cash flow health. A sustainable payout ratio, ideally below 60%, indicates that the company isn't stretching its profits too thin to pay dividends. Another trap to avoid is chasing ultra-high yields. A 10% dividend might sound amazing, but if the company's stock price is falling or its earnings are shrinking, that yield won't last long. Always prioritize safety, stability, and growth potential over short-term excitement. Remember, consistency beats flash every time when it comes to retirement income. So, how do you start? Begin by opening a brokerage account that allows you to buy dividend-paying stocks or ETFs. Set a monthly investment goal that you can stick to, no matter how small. The key is consistency. Track your dividend income and celebrate small milestones, your first $10, your first $100, and eventually your first $1,000 in dividend payments. It's motivating to watch your money start working for you. If you're younger, time is your biggest advantage. The earlier you begin, the more compounding can work in your favor. But even if you're older, dividend investing can still be a fantastic strategy for retirement because it provides stable income and reduces your dependence on market timing. You're not forced to sell assets when markets are down. You can live off your dividends and let your portfolio recover naturally. Imagine waking up one morning, checking your account, and seeing that your investments just paid you for doing nothing. Imagine knowing that every month, cash flows in whether you're traveling, sleeping, or spending time with family. That's not just financial freedom, it's life freedom. Dividend investing can make that a reality, but only if you start and stay committed. So, whether you're just getting started or already investing, focus on building a portfolio of solid, dividend-growing companies. Reinvest, stay patient, and let compounding do its magic. The day will come when your dividends cover all your bills, and that's when you'll know you've achieved financial independence. Thanks for watching Stock Predictor. If you found this video valuable, hit that like button, subscribe for more investing insights, and turn on notifications so you never miss the next wealth-building strategy. Drop a comment below and let me know your favorite dividend stock or how much dividend income you're earning each month. Remember, every dollar of cash flow brings you one step closer to financial freedom. Stay smart, stay invested, and I'll see you in the next video.